Hey everyone, welcome back. It is Tuesday, and sorry for my late delay here. I am completely blind. I have one of my monitors just died, my monitor that I share everything with. So that's making it a little bit difficult to try to stream out to you guys because I don't really know what to do. And I'm trying to figure out how I might make this work today because I can talk to you, but that's not fun. I need to be able to show the screen, and I literally have no monitor. It's just black right now. I don't know what's going on. So hopefully you can hear me. If you could let me know, that would be great. I see a couple of you have dropped off already, which is fine. I didn't expect you to hang around if I'm just sitting here doing nothing. Why don't you let me know if this audio is coming through correctly, which it looks like it's streaming, and then what we might be able to talk about. Just wondering, like, what could I do? I mean, I could go from my phone, I guess. I could get all crazy. Where is that cable? I think I've got the ability to stream from something else. This is the woes of being a YouTuber. Sometimes we have to deal with this stuff that's a little bit out of the ordinary. Just looking for a cable here. Let me see if I can use my phone. So, and of course, it's a crazy day. Wouldn't it be nice if we could... I don't know if this is going to work at all. That's probably a bad thing to do. No, that's not going to work. Okay. Let's talk about tariffs. I'll just talk to you guys. Can hear and see me. Sound is good. Thanks, Mike, for letting me know. Thanks, everybody, for letting me know. Yeah, I have no monitor. So what can I do? I can't even like turn a camera very easily to say, here's the monitor. But what are we looking at? Let's just run through kind of what is going on. And yeah, because I can't switch anything. This is terrible. I restarted my computer. Technical problems are always like hard. Thanks, Mike. I appreciate that feedback. Maybe just an overview of what I feel is going on. So obviously, for premium sellers out there, everybody's getting hammered. I saw just before I started this stream that Tom King closed his whole position. I mean, he runs those 112 trades, which are extremely dangerous trades when the market goes down and the volatility expands. So I'm not surprised that he's down supposedly around like 40% of his account. That's a pretty heavy hit. And I mean, that's the second time within 12 months that those accounts of his have been hit that way. And I'm not trying to diss those types of trading. I mean, one of the discussions we had the other day in our Discord was interesting because I actually have some affiliates that I've been building and working out with and saying, hey, who in the creative space, in like this YouTube space, is out there in the world that aligns with my goals and puts on strategies that I would consider myself. Now, I've been trading a long time, so when I have pigeonholed myself into a very specific type of trading, and I trade options, and I use forms of diagonals, butterflies, limited loss trades, unlimited loss trades when volatility is high, and I use this to create an income flow over time. I pair this with long stocks when opportunity arises, and I sell covered calls in some of my accounts. That's generally kind of what I do. Now, I have attempted to trade 0 GTE strategies. I've also attempted to trade, like swing trading type things, scalping, some people call that. With those types of trades, I have found that, I didn't really love doing those things. And I always kind of reverted back to options because they made sense to me and they allowed me to kind of adjust the risk in my portfolio. Now, that being said, as a YouTuber, my goal is to help people build wealth. That's my primary goal. It's the thing that I love to talk about with traders, with non-traders, and everybody has a different story. Everybody comes from a different place. So sometimes that means I'm talking to young, like college students, and they're looking for a way to kind of break into the market, or I talk to people that are maybe retired and they have a nest egg and they want just something that they can engage with, and they can say, hey, how do I make some more, potentially some more money, or how do I maybe reduce my risk, and are there some creative ways to do it? And in doing so, what it has done is it's led me to kind of seek out people that are alternatives to services like mine. Now, of course, I do run a paid service. The idea being that the paid service allows me to really focus my time and say, hey, I can help you guys. You have me at your beck and call. When you've got a question, I just answer and we go from there. Now, I'm not a financial advisor in any way, shape, or form, but I have lots of experience. So that's why I am looking at the things that I do and how I kind of move forward with my service. There are other services out there that are pretty awesome. And one of the things that came up in the Discord the other day was talking about Liberty service. And I'm going to post I'll post a link right now in the Discord chat, not in the Discord chat, but in the YouTube chat. And what this is a link to a friend of mine, Felipe. And now we have been conversing now for the last couple of months, and he is a totally different style of trader than I am. And the reason that I am looking for people like this is because I think that to have a comprehensive ability to kind of service the needs of people, it makes sense for me to align myself with people that I think have great services. Now, kind of going full circle back to my introduction where I talked about Tom King losing 40% of his portfolio. Like I think Tom seems to be like a really great guy. And he also runs paid service. I took a look at those trades and I don't feel like the risk profile is right for me. So, and I'm not trying to bash him in any way, shape, or form. I just want to say that he doesn't align with my values, and the trades for me have too much risk on, and it's unfortunate. And I feel for anybody that's out there that's looking at those types of services, because I've seen people come into my group and say like, oh, they're trading with Tom King style, and then I look at the risk profile, or I look at some of the position they have on, and it's astronomically crazy how much risk we can take. We can leverage ourselves up way too much using options, and it really, really hurts. Now, I'm not saying I'm not hurting in this environment. I have been leaning the long the last couple of months, and I kind of have some profit tents in play, playing with those lower volatility plays, and then expanding out into this higher volatility has been not great for my portfolio overall. Now, I am definitely not just closing all of my trades, because I don't think that these are long-term sustainable ways to trade. If we're looking at a situation where we have to just like throw our hands up in the air and say, holy, I blew my account up again. And we talk about that all the time, people blowing up their accounts. And I think that it's important for anybody out there to be really looking at that, the amount of money that we're risking, and saying, hey, does this make sense? Does the potential reward make sense for the risk that we're taking? So when I look at Felipe's service, Liberty Signal, which I posted a link to, his service is totally different than mine. And it's interesting, over the past 4 months, he's actually showed a slightly positive return since December. Now, the whole thing for him is that he stays in cash, and he looks very much for swing trades. Now, there hasn't been a huge amount of swing trades that were very viable, and he had some wins and he had some losses. He's very transparent. If you guys use that link, click over to his service and check it out. He has the past 5 years of every single trade that he's done. He does about 200 trades a year, and it's pretty interesting, because when I compare it to the type of stuff that I'm doing, my potential is relatively capped, and I can dictate how much risk I put on. And I'm, generally looking, like, I aim for that like 15 to 20% per year, but it's hard for me to get much more than that in most cases, except for with covered calls. You can do, last year we did 40% on covered calls, which is pretty amazing, but I think that's out of the norm. It was just like a good bull year. And this year, a good chunk of those gains have been taken away from us because they are covered call positions. So when the markets draw down, we have that drawdown occur. When I look at different styles of trading, I keep going back to, what do I want to complement my stuff with? Because I know that selling a put is a high risk trade with a relatively low reward, but lots of consistency. are there other options out there? Are there the, big butterflies where we have a low amount of risk and then a large profit tent? And are those viable strategies over time? And it's interesting to look at different services and how they offer different things just in general. Got a couple questions here. S. Smith says, I have a question about your option trading journal. I just downloaded it. It looks like it's designed for single leg trades. How can I use it for more complex multi-leg strategies? It's a great question. The very first column A in the options trading journal, you can put any sort of reference number in that. So there's a video. If you look at the link at the top of the file, you can click and watch the YouTube video, but there's a file. And if you put in, like say you said trade number 1 and you just put in 1 in the first row, and then any other trade that you want to track with that you just put that same reference number in, then there's a little sorting sheet that you can use. And what it'll do is it'll pull up all the transactions that are, and it'll just display the transaction from the log that relate to that reference number. So that's the easiest way to do it. So some people just do it by number. I know off the top of my head, like Shadow Trader, he uses like a number reference. My preference is to use a reference where I use the symbol and then the date that I entered the trade. So my references usually are like ARK-K space March 6th. And then that gives me some context as to how I might sort those trades out. Options journal is a very powerful piece. I use it primarily for like selling poor man's covered puts, where I've got like a long put position and then I sell some puts against that on the dailies. And though where I know that I'm going to be holding the long put for quite a while and I'm going to be selling quite a few of the short puts against it. But the options journal is very powerful. You can buy stocks, you can do dividends, pretty much anything you need in that sheet. And it is designed like a log. So every single transaction just gets entered. Now, I'm sure that some people would try to use that or could use it. I'm not saying try, you could use it in the type where you just create one sheet per trade rather than using the filter sheet. So depending on the style of trading that you're trying to track, that might be a better option for you. So, but that's how you do it. Typically, it was you just put the reference letter in and then you can sort by reference on that other tab. And it shows you all the results of that, which is fantastic. DS, have you used GEX in your trading 0DTE? What's your view on that in general? I haven't. There's been quite a lot of discussion. Mike probably could jump in on GEX. And yes, DS is saying gamma exposure. So yeah, I am familiar with GEX, and for those of you who are out looking at gamma exposure, is basically the velocity at which the options are going to change price. I haven't used it. I know like Bill Baumeister on Facebook and the Tasty Options group, he uses GEX quite a bit. He's got some very complex charting that, and they're basically looking for nodes. So they're saying, which options have a large amount of gamma exposure. I don't actually know. I haven't done enough research on it to know where the data is coming from, but it's similar to like a VWAP style trading where you're looking at the volume profile of specific strikes and saying the likelihood is that if there's lots of volume in a certain strike, then the move is going to happen and it's going to go up to that node or it's going to go down to that node. And we can see what that the kind of momentum indicator is based on GEX. I would love to explore it more. I know Mike has emailed me about it, and it's something that's kind of on my list ongoing of how to improve some of the stuff. I've kind of I've been talking about this quite a bit. A friend of mine and I are working on some more automated type strategies. One of the issues I'm running into personally with my trading, it has nothing to do with trading per se, but it has to do with my Interactive Brokers account. And I don't know why they're being so terrible, but the platform has just gotten slower and slower and slower. And it's gotten to the point where I'm having to like flip back and forth between my phone and my desktop because I'm just trying to like put on a trade and the desktop is taking forever. So I'm really kind of going down this rabbit hole of saying, okay, well, when I want to put on a trade, can I do an order entry using the API for Interactive Brokers rather than actually put the trade on through the Interactive Brokers platform, which seems to be deteriorating and has been for months. The 2 weeks ago, we found out that Tasty Trade is definitely not coming to Canada. They've removed their application or however that went down, but they're not coming. We have options like Webull and Moomoo out there. I haven't traded with those platforms, but I feel like most platforms have a similar sort of negative connotation with them. So there's something good and something bad about every pros and cons of every type of platform. When I look at what Interactive Brokers is doing, and then where the style of trading that I'm doing, how those are functioning together, I realize that there's a real gap in the market. There's not a program out there that can connect Interactive Brokers to me as a trader and bypass that. Now, we've got systems like Trade Automation Toolbox, and feel free, if you guys know of one, please just type it in the chat. I mean, I would love to try to build a community. One of the things that I like to do is try to share as much as I can about other things that are out there. So the rabbit hole that I'm going down right now is looking for these types of programs like Option Omega, Trade Automation Toolbox. We've got Tammy Shambliss over doing like automated MEIC trades, looking at like DAS and Ninja Trader. None of these seem to offer a full service. Sorry, my screen's just shut off here now. Full service option trading automated through Interactive Brokers API. And what I would like to do is get that working, because some of the trades that I've been putting on they could easily be automated. And I'm wondering to myself, well, why, especially if I'm fighting with my brokerage platform, am I putting on this trade that is frustrating to put on? Not only is my time gone from putting it on, but I'm frustrated with doing it. But that, ultimately I'm trying to put on trades that make money. That's the goal. But I also want to free up some of my time as well. That being said, there's tons of options out there, so many choices. And this last year has been a big change for me. It's been, connecting with people, going to seminars, going and like looking at what people are offering and saying, what does the next year, 2 years, 5 years, 10 years look like for me as a trader and as a YouTuber? And are we going down a route of automation? Does the automation outperform? Should we be fully automated? And I, at this point, up until now, for the last almost 30 years, I've been a fully manual trader. So I've looked at, what the entry point is, and I've made those decisions. When I'm wrong, I have myself to blame. And I think that in times like this, when we look at the market in general and we see that they're coming down, there's a lot of pain that people feel, myself included. We don't want to blame ourselves, but we have nobody else to blame when our accounts are down. I mean, I made the choices to pull the trigger. I make any trade that I made in my account, whether or not it was something I read, looked at, assumed. It's always my choice. And that is hard. It's hard when we have drawdowns. It's great when we're winning, and it's hard when there's drawdowns. And I think that if I can partially automate some of those trades, whether or not they're losers or winners, it's going to remove me slightly from the process, because I am not there individually picking. Instead, what my plan is to have formulas that are basically back tested off very specific parameters and rigorously applying like a Monte Carlo situation. So we see a full projection of what the potential outcomes could be, good or bad, and not just assuming that we're going to be like winners all the time. And then having bots basically automate these trades in place so that I'm monitoring the bots, but I'm not so specific about putting on the trades. And that's kind of the goal that I have over the next couple of months. And I wish that I could just I wish there was some magic service that's out there that did that for us. There doesn't seem to be. So I think that if I want it, there has to be other people that want this. And this is something that I can say, on Thursdays, I've tested this before. On Thursdays, I have a bull put spread that I want to put on, and I want to collect, 50 cents for $5 wide bull put spread. And I want to put a automatic limit, like a stop limit order on that, or a profit taker. And can we do this? Can we do this without interactive brokers or without our trading platform so that we can be a little more personally automated? So I'm pretty excited about it. And I would love for, if you guys are listening to this and thinking that resonates with you, then please send me an email and say, hey, like, this is the type of trade that I'm looking at, or the type of trade that I do, and this is what the success rate has been. And these are the types of things that I would like to be able to program into my own stuff. And I don't have a way of doing it right now. So if you're building this, can you build it out for these specific parameters? The more people that give me input, the better the product is going to be when it comes out. Now, we are super in early stages at this point in time. So there's a lot of ideas being floated around, and I don't know how well it's going to work, how much we'll have to charge for it, if we can even publicly release it. But at least we can have a kind of an ongoing discussion about it. And I think that there's trades out there that people are doing, and if you want to help create, something great, or help people make more money, sharing those thoughts on things that work, things that are working, that's where we can kind of team together and say, let's build something amazing. Because that's what we're trying to do. We're trying to build, not only a community, but build some wealth so we can give back. That's kind of the thing. That's what I've been doing that's why I sit here every week, and I've been doing it for 8 years. Because I feel genuinely that when I speak to people, I hope that I'm inspiring people to say, let's take a look at my investment. And maybe it's as simple as just saying, like, can I talk to my accountant to reduce my taxes? Maybe it's something as simple as that. Those types of things are fantastic. And I just want to build more of that. So let's see, we've got some comments. Mike Miller says, since the tariffs and the rise of the VIX, I think I've said price can't possibly go there. Just to sit back and watch it go there and then some. Absolutely wild. You know what? I can't agree more, Mike. It's been, the days have been huge when we're seeing those like 5.8% moves in the market, and almost hitting the circuit breakers. The moves are big. They're big. And I think that from premium selling perspective, even when the VIX hit 60, which what is the VIX at right now? The VIX is at 48.97, which is astronomically high. We've gone entire years where we don't even see over the 30s, and we're just sitting repeatedly at this high level VIX at 48 level, up 4% change today. Even at these levels, when we're selling premium, we know that we're getting a lot of premium, but is the premium even worth it? We're still getting steamrolled on some of these positions. It's the moves have been right at, I looked at a chart just the other day, I wish I could share it with you, but there's a right at the expected moves most days. So, which means that the market makers are getting super smart about how much they're charging. They have got everything so dialed in that the premium that we're paying, or the premium that's being collected, is exactly where the move is happening. And it's happening like day after day, almost perfectly, which is wild. So the only way to benefit from that is to have automated systems that are kind of scalping, so to speak, but taking small bites out of the positions rather than looking for the move. Like, we know that if we buy strangles or we sell strangles, that this is like a net sum zero game that sounded terrible, a net zero sum game when we do it over the long term. And the reason for that is because market makers, especially on short duration, have those quantities priced to perfection. They have perfect pricing, and they're getting better all the time. So it's hard for retail traders. We just don't have the ability to get into the data that we need to actually make money. And being directional seems to be the only way to do it. Now, that being directional can mean one of two things. We could be long options, or we could be short the options, or we could be long the stock or short the stock. Either of those things, any of those work. It doesn't necessarily mean that just because the VIX is high that buying buying options is out. It's harder because there's lots of decay, but it doesn't mean that it's not winning. So I think that the money's moving around quite rapidly, and we just don't know what's going to happen. Brian says, if you take a look at tickers, you can take a look at fair market values for CVS, ADM, VC, CNC. Thank you. Brian, I don't know if you're here from the beginning. My monitor died just before I started the stream, so I'm running blind today. So you just get to look at my face today, unfortunately, and we're going to just talk about the market in general. CVS, ADM. I mean, I can give you Michael's notes on those, but I just can't share the actual. Let's just look at CVS here. That's wrong. CVS Health Corporation. So fair market value on Investing Pro is 95, and it's currently trading at $67, up $3 today at 5.4%. On the 1 year, we're looking at minus 5%. So with those types of companies, there's quite a bit of potential upside. I really think that trades like poor man's covered calls could work very, very well. When we have a fair value that's that much higher, 42% higher than the current value, then there's a potential of that stock going up, and it has been relatively neutral over the past year. So I would be looking at like call diagonals or call spreads above those prices just to try to capture some value. Now, one of the things we can do is we could like pair, if we thought that the stock was going to go up and we wanted some exposure, we could pair a bull put spread with a bull call spread. So we do a bull put spread below it, which creates a credit, and then use that credit to purchase a bull call spread above. And that gives us a profit profile that's kind of flat and then has some profit potential and limited loss on both sides, or limited gain and limited loss. So just kind of structuring, using the kind of iron condor analogy and saying, well, okay, can we make this more directional one way or the other? And I think that's smart when we get into super high volatility to look at things like that. So to take a look at these other ones, ADM, I'm not actually familiar with that ticker, so thank you for sharing it. Archer Daniels Midland Company. Again, it's trading below its fair value, 61% upside. The stock is down 30% this year. Interestingly enough, that the high on the year, 63.84, is actually below its fair value, according to Investing Pro, which I think was a little bit fishy to me. And again, I would be looking for everything selling off. So the smart investors are starting to say, well, can we pick up the pieces? The problem is we just don't know what the recovery is going to be like. If we are in a recessionary period and we've got this ongoing stock market sideways movement or down, is there going to be a recovery at some point, and how long away is that? Like, what's the time horizon? So I really like to play with the options in these cases. So even if I was buying stock, I would be considering, capping that profit, selling call spreads above, or maybe selling puts to enter these trades to get into values. Remember, a short put, I was just looking at an email I got from another service that I subscribe to that gives these it doesn't matter. I got a post, and it was like a collar strategy on a long stock position. So it's buy stock, buy a put, sell a call. So you've got capped upside, you've got capped downside, and you've got long stock. And I don't really understand why are we doing that? Like the profit profile of buying a put, buying an out of the money put, selling an out of the money call, and buying stock is the same as doing just a simple put spread, like a bull put spread, where we buy the same long put, and instead of buying the shares and selling the covered call, we just sell the in the money put. We collect the credit for that. The profit profile is identical. So I'm a little bit confused when I see stuff like that, when there must be some sort of reason for that type of trading. So I understand why you would trade like that. You want a, married put makes total sense, and then the covered call to pay for the married put makes total sense. But why do a three-legged trade when we can just do two? And that's where I'm a little bit lost. I'm going to reach out to them and say, Why? What is there some sort of management in here that's happening? But that's what I would be considering with stuff like this, is saying, is there a chance it could come down? Absolutely. Is it a put spread below or a short put below? And then is there some opportunity for the upside, and how can we best build that? One of the things I like to do is build broken wing butterflies above the stock price. So it gives me a profit tent where it's most likely to go. Now, if I look, I know you guys can't see, but if I look at the shares, like right now on this ADM, Archer Daniels Midland, the shares are currently trading right now at $41.97, so $42. Now, a week ago, they were at 48. And there's quite a bit of consolidation from February. So basically from February to March, it was trading in that like 48 level. And so even though the fair market value, according to Investing Pro, is $67, I don't think that we're going to go to 67 next week. I don't think we're going to go to 50, 55 even. We might get there, but it may take a year to get there to that fair value. So if I was to buy stock, would I rather be, selling, a call at the 60 level, way up above, and collecting a few pennies and saying I've got lots of potential to the upside? Or would I rather, sell the 50 call and say, okay, well, I've capped my profits at the 50, but I collect a lot more premium by doing that. And because it's not very likely that we're all of a sudden going to turn around from a 30% drawdown over the year to like rebound back up, to the 67 level instantaneously. One of the things we can do with that is if we build butterflies around those levels, we can actually collect a little bit of premium, and we can say, hey, what if it goes back up to this 48 level or around that 50 level? Is it in a profit tent? It's a good way to think about things, I think. So just, trying not to be so basic with our trading and saying, okay, well, what if we just sell a put or just sell a call or just do a spread? Verizon, Verizon is, I can't imagine that it's much off its fair value. Yeah, so $42.44, fair value $42.08. So it's basically at its fair value. The telecom companies they have tight pricing on those. Those are tough investments over the long term. I took off my exposure to telecom. I think that they're in a game, especially in North America, where prices are getting cheaper, that the margins are getting slimmer, and because people want cheaper and cheaper services, and there's more infrastructure required to offer those services. And CNC, which is Centene Corporation and the New York Stock Exchange, $62 current price, up 2% today. The 1 year it's down 14%. The fair value $79.87, or 27% prior or higher than the current market valuation. And lots of shares being purchased back, and high shareholder yield. And then trading at a low price to earnings ratio relative to the near-term earnings growth. So those are kind of highlights there. Good financial health for that company. So that's a nice one if we're looking for long stocks to be buying at a reasonably discounted rate. You're getting a 14% discount from buying it 1 year ago. If we look at the 3 month, it's relatively in the range. So it's kind of the mid range of where it was in the last 3 months. High being $65, low being $55.93, currently trading at 61. So again, this is where I might look for, put selling if I wanted to get long exposure. And I can do that either below, say like a 60 put, or if I want some upside potential, I can just sell a 65 put and collect that premium right off the top and have a little bit more upside. It's the same as buying stock and selling a covered call. And again, just trying to keep everything as simple as possible. Unless we're in registered accounts, there's very little reason to buy stock most of the time. Unless we want to keep if we're the type of investor that's saying, I want to do 2% of my account to this stock, and the account is small enough that 2% doesn't equate to 100 shares, then obviously we need to buy just the shares to say, well, that's my exposure. 2% of my account might be 2 or 3 shares, or maybe 10 shares or 20 shares. But if it's over 100, then that's where I start to look at least for 100 lot doing a short put or and getting exposure that way, and then adding the extra shares in there to bring it up to my whatever percentage I want to allocate to a stock like that. John Blake says, happy Tuesday. Always good to have you here, John. Appreciate that. I love that you have such like a smiley picture on your little avatar there. Most people just show up as a initial. So John, I really appreciate that. And sorry, S. Smith, I don't know why your message was retracted, but hopefully you were able to retype. S. Smith says, I believe Option Alpha does robotic trading if you link their platform to your brokerage platform. It is on my list to check out. Kirk over at Option Alpha has been doing what I've been doing for absolute years. And again, that's just another reason why I'm looking at these, because Kirk Duplessis, he is an absolute powerhouse when it comes to calmness and delivery of really great stock option information. So if you guys aren't familiar with Option Alpha, their videos are fantastic. Like, I mean, he does an excellent job. They've been doing it for a long time, and that's exactly what happened to them. They were looking at what they were doing and saying, okay, we got to a point where everything's so distilled and we're just like robotic positions now. We're just clicking the mouse, and it's like, how do we fix this? How do we make it accessible to people? And they've gone that route. Now, I don't believe they link to IBKR. So I will look into it again, but this is exactly what they're doing for other places. I want to be able to do that for other brokerages. And I think that there's enough room in this space for everybody to kind of play and for different services to exist. Because similarly, like I now consistently use both Seeking Alpha and investingpro.com, both of those services. And I feel like even though they're very much competitors to one another, they are helpful to me as a trader in two different ways. And I love that I have both services. I used to kind of not pay attention to that kind of stuff, and I feel like it's made a lot of what I do in general much easier when I have a little bit more information, just to easily be able to look at that stuff and say, hey, does this make sense? I'm just gonna pull up here because I'll post those right now. I'll post the links to both of those if you guys are interested. But those services are, you look at them, and I posted them in the YouTube chat, but you look at the services and you're like, is this worth the money? And when we're trading with the volume that we trade, it's impossible for us to be able to go through all the paperwork and really say we've done due diligence in these accounts. So I have to look at the outside sources and say, at least let me get some sort of baseline feedback before I really dig into stuff, especially if we're going to do option trading, which is a range trading style anyway. So typically, I'm not looking for specific entry. I'm looking for a position that's going to, make money in a range. So that's how I'm looking at stuff in general. And SPX just dumped 1%. Could be another fake news. Yeah, SPX is currently showing negative on my screen, down 0.5%. And I'm just going to pull up the chart. It's been I've got the 1 minute. It's just been a day. I think this is just what's happening. We're in this move, and everything's kind of slowly filtering down. The question is, are we going to filter down like all the way to October? That is, or are we going to be short-lived? Typically the VIX doesn't jump this high this quickly, and so it's a very very tough market to kind of navigate, because what could happen? I mean, if the tariffs get dropped in any significant way, I can see this market just running up so quickly, and we'll have a very V-shaped recovery. And if we don't see that, then are we grinding down, and how far? We're already down 22%. That's a long ways. We're in bear market territory on NQ for sure. I don't know if on SPX we're currently there, but and then the Russell also down. Russell's the big loser today, down 1.7%. And then the VIX spiking at the 48. US oil trading below $60 a barrel at $59. Guess we didn't even do this off the top. And gold trading down at 29.87, up slightly today. I think there's opportunity in gold. I feel like we could be in a situation where gold is at $4,000 an ounce by the end of the year, which, you know, seems crazy to think about that and where it could go. But when the market flows back and forth between things, if we saw gold retrace with markets running up yesterday, and if the markets do continue to grind down, there will be more money just flowing into gold. So I would expect that we'll see some more upside there. As for opportunity, there seems to be tons of opportunity out there to get into stocks at really low levels. Like, you know, Apple, obviously with their exposure to China, and now the new Trump tariffs at 104%, pretty crazy. But for the first time in a long time, Apple's trading underneath its fair value. And that's just today that happened. So for months, we've been looking at this. And every time we talk about Apple, we say, okay, well, Apple's trading above its fair value. Today, it's now trading below. So what does that do for the stock? It's interesting because there's people out there that are looking at this and saying, this is an opportunity for buying in the S&P 500. You know, might not be great to trade options on it, but what about just long-term buy and hold positions? If anybody was sitting on cash for the last couple of months, there's opportunity here for new positions to be put on. So it's pretty interesting. What else do we have here? John Blake says, thank you. You're very welcome. Just some idiot on YouTube. I love that name, by the way. Try not to use words like idiot, but that's fantastic. Thoughts on the wheel strategy for passive income? I love the wheel strategy, and I hate the wheel strategy at the same time. You know, the issue with the wheel is that when the stocks start to go down, it really sucks because you end up in a position like any covered call strategy. You are exposed to the depth of losses that can incur by having either a short put or a long stock or covered call position, because the risk is high relative to the return. So it's a high risk, low return strategy. And, you know, ultimately, if you're really good at stock picking, then it's a great strategy. And if you're not so good, or even if you have the occasional loser, then it's not so great. Unfortunately, it's one of the strategies that we can do in any account anywhere in the world. So it becomes, the wheel, I think, has to be part of most people's strategy toolkit. Because if you don't have it, what are you going to trade? You know, you have to have positions where you're long stock. So you're either long stock without the calls or you're long stock with the calls. Does it make sense to enter a trade with a short put? Absolutely. Does it make sense to enter a trade with sell covered calls against the stock? Most of the time, yes, it does. Sometimes you cap your upside. So it is difficult on some stocks. Some are better than others. What else do we have? Christina says hi from Naples. First time on one of your live chats. Well, thanks, Christina. That's fantastic. You've got a little picture there too. I can't really see, but thanks for joining. Been long on Palantir since 2020, but just started option trading in the last few months. Well, Palantir has tons of juice on it. So I'm actually short Palantir. I'm not short the stock, but what I have on is a bearish put spread, and it's very, very cheap, this particular spread. I think it's from June contracts, and I have the 40-42 bear put spread, and basically it costs like $3, like 3 cents for the contracts for that $1 or $2 wide spread. So it's like a $3 bet to win $200 if we see Palantir down at that $40 level. Now, Palantir is interesting because and for those of you who are just joining me, and my apologies, I can't share my screen, but my screen went dead right before I started the stream. So Palantir's fair market value, currently $38.69. It's trading right now at $79. So that's a downside of 51%. And that's why I have that in. And this is where I was talking about those links that I posted. For those of you who are wondering like what services I use, how do I get some of this information? I don't love to do the math. You know, I can do the math. I can go in and I can look at all of the sheets and say, how much money are they making and how many shares are outstanding? And I can find out all of this stuff, but we have algorithms that tell us, and they're not that expensive. So that's why I'm a fan. It's what I'm using. And that's all we talk about here is what I'm doing. This is when I would normally push my disclaimer button, but I don't think maybe I can do it manually. Let's see how technologically inclined am I here? There. Oh, look at that. I got my disclaimer up there finally. Disclaimer, not financial advice in any way, shape, or form, just what I'm doing. What else are we looking at? So congratulations on going to options. Palantir is there's a ton of premium in there. So if you're looking for stocks to trade options on, like a wheel strategy type things, then Palantir is one of the best ones because there's so much potential for it to go to the moon. So the premium on the calls is just massive. You can go up nicely above maybe your entry price and say, okay, well, I can sell these calls and collect the premium. And then if they get tested, you can typically roll them up to a higher strike and still get paid more. So it's like you get paid and then you get paid and then you get paid. Pretty awesome. I've done some complex strategies on it, and it whips around quite a bit. So you kind of have to I like to pick a trough, so to speak, or pick a strike and say, okay, this is the level that I'm going to be at. Val says, hello from Oregon. Snowbirds on our way home. Really enjoy your channel. Thanks, Val. I appreciate that. And I love it. I love that you're a snowbird. Are you familiar? I got to ask this. I found this out recently, and I can't believe it, but TELUS has this deal with snowbirdadvisors.ca, and you can get a corporate plan for half the price of a regular plan, and you can use it in North America wide, Mexico, US, and Canada. So if you haven't heard of that, check out snowbirdadvisors.ca. I won't post the link here, but I'm not an affiliate in any way, shape, or form. But if you're snowbirds, it might save you a couple of bucks. Just some idiot says, haha, thanks, bud. And he says, what do you suggest is a better option for passive income instead of the wheel strategy? Well, this comes back full circle to there's passive income is, if I want a passive income, which is not option trading, passive income is I do nothing. That's passive. Option trading is actually active trading. It could be not super active, but it's still active. And if I wanted passive income, I would look at the Roundhill products, ETFs. I have no affiliation with them in any way, shape, or form. I have done videos on them before, but they have covered call strategies that they use, like zero DTE covered call strategies on the S&P 500, QQQ, or sorry, the NASDAQ, Russell, and Bitcoin. And those are crazy. Right now, the yield on them is 22%. And basically, those are passive investments. You buy the shares, you buy the share in the ETF, and they just pay a dividend every single week. That's passive investing. I think that most people would not be able to perform as well as those funds would, because they're daily executed. They're very much taking care of the algorithmic side of things, which is, if I want to passively sell premium on something, I have to either sell on the weekly or the monthly. So I have at minimum typically 12 transactions a year that I have to do. On underlyings that I trade every week, I have 52 transactions that I have to do. So neither of those are very passive strategies, and they don't take care of zero DTE. If I wanted to do zero DTE, I would have to do 252 transactions a year, not passive at all. And I would have to be in my, at my desk doing those trades. Roundhill wraps those all up into an ETF and pays it out as a dividend. Pretty flippin' amazing, I think. So that's what I would look at. If I was, and in fact, I have. I'm not even talking about things I don't own. I own those products because I don't want to continually trade the wheel forever, weekly, on things that it makes me lots of money. But I think I can make just as much, if not more, using some of these newer products that are out here. Christina says, I'm getting killed on a covered call right now. To the upside or the downside, sometimes people say they're getting killed on a covered call because the stock price went up and they missed out on opportunity. That is, I believe that's the wrong way to look at things. I actually like when my covered calls go in the money. That means I'm at max profit. Covered calls that kill me are the ones where the stock drops off and I'm like, well, now what? I'm like way down on my shares and I didn't sell the call. So I've talked to enough people over the years. Usually people are complaining when they've made money and not when they've lost, but I tend to complain when the market goes down. That's when it sucks. Having a covered call is that you didn't collect enough premium. You bought the shares, you sold the call, and then the stock just tanked. That's the sucky side. If it goes up, congrats, you made some money. Just some idiot says, Christina, have you rolled over money? Which ticker and which option? Might have to roll it. Yeah. So if you're talking about rolling it, Christina, then you're on the winning side. So feel free to post the ticker and the option strike, and we'll take a look at it. Val did not know that, but Freedom Mobile works great for us. US, Canada, Mexico, lots of data. We'll check out Telescorp account out. Yeah, it's an interesting. It's like $55, I think. I learned about it fairly recently. Signed up and we're doing a little Texas barbecue trip this year. Can't wait. For those of you guys down in Austin, I am going to be coming for a visit late August, and anybody else en route, we're going to do like kind of wiggly route and do some national parks and things like that. So it's going to be kind of fun. I've been talking about it for way too long. I can't wait to get my teeth into some fantastic Texas barbecue. I've been only to the airport in Houston and now I'm doing like a full trip. So it's gonna be great. I'm excited about that. And just some idiot says, well, when I look up Roundhill, I see a ton of different ETFs, which is the best to trade. So I did a video on it. You should check back. It was pretty recently, but the ones that I bought were the index ones. So XDTE, RDTE, QDTE, and YBTC. Those are the four that I like. And I do have a very specific video on how it kind of breaks down and why I chose those ones. Christina, $70 covered call on Palantir. Well, then you're in the money. That's like a fantastic place to be. Palantir's trading at $78 right now. I'm just going to zip over and look at the options right now. But what expiration, Christina? If we look at the options, I'm pulling up the chain. I'm sorry I can't show you this. My screen died. The 70 strike calls on the 11th are let me just change this to straddle view. Have about like over $1 in premium. They're worth 10.45 right now, and the stock's trading at 8.74. So even waiting until the 11th, which is 3 days away, those options, if the stock doesn't move up any further, then those options will get cheaper by $245. It's wild how much premium there is in there. So I definitely don't like to roll until the extrinsic value is gone. And right now, the intrinsic value is the amount of money they're in the money. So if you've got the 70 strike, stocks trading at 78.80, that means there's $8.80 in intrinsic value. And then the 70 strike is worth 10.45, which means the other remaining money, that other $1.65, is extrinsic value. So I typically wait till the extrinsic value is gone, then I roll. So the risk right now is Palantir drops, the whole market drops, but by holding it, it's like, even if it goes up further, guaranteed to make another $145 or $165 in extrinsic value. The risk would be obviously that the stock drops to like $60 and now you're out your money. So congrats on that trade. That's for April 11th. Now looking at the April 17th, if a trader wanted to roll from the 70 to the 70 strike, from the 11th to the 18th, there's another $1 in extrinsic value a week later. So you're literally making over 1% a week. So 1% would be 70 cents on the $70 strike. And if there's $1 in premium for 7 days, that means it's like a 1.4%, or about 70% annualized. So nothing to complain about on those types of positions, making 70% return just by rolling the 70 call repeatedly week after week after week. Again, the risk is when that stock goes to 40 and your $7,000 position, which is currently worth $4,000. That's where the risk is. So good luck with that trade. I would not, if I was in that trade, I would not be super aggressive about trying to roll up that position. I would be very, very happy keeping a large degree of safety on and be very content with collecting 1% a week, because making 50% this year, like let's just say it just keeps going up and up and up and you made 50%, that's amazing. Like a lot of people aren't doing that. Most people are getting killed on the downside in this market. Doesn't matter what you sold it for, Christina. The current price is all that's relative, because you collected 443. And when you talk about rolling out, you're just going to I'm sorry, I'm reading this question, but sorry, I didn't just freeze. I'm frozen because of the comment. But if you sold the 70 strike for $4.43 and you have to buy it back for $10, that doesn't matter. The credit to roll is what's more important. So consistently rolling for a credit, even at the same strike or slightly up at a higher strike, which could do on Palantir, because if there's $1 per week, then you could use that dollar to move up to a higher strike. Again, that's adding more risk for very little gain at that point in time. Just Some Idiot says, but if you sell a covered call and the stock goes down, you make money. Did you mean the opposite? No, that's incorrect. Just Some Idiot. If you sell a covered call that means you own the stock and you sell the call. That's a bullish position. It makes money if the stock goes up. It loses money if the stock goes down. And I'll just give you a very easy example. Buy a stock for $70, sell the call for $70. If the stock drops to $40, the call expires worthless, and now you have a $4,000 position or $40 per share position. That you paid $70 for minus whatever you sold the initial covered call for. Covered calls are bullish positions. They want the stock to go up. Christina says, I would roll that if it's below your cost basis. It really, cost basis, that is one of the things I am going to be super adamant about. People should not worry about what their cost basis is. I see way too many traders saying, oh, I can't sell a covered call on this share. Let's say you bought a share for $100. Stock drops to $50. Why wouldn't you sell a covered call at that level, at that $50 level? If the stock is trading at $50, it is super unlikely to jump back up to $50. So what we're trying to do as traders is to make money off the positions that we have. We don't have time machines, so we can't go back and say my cost base is $100. I'll give you another example as to how silly it sounds when you talk about cost basis. If you were to buy Amazon shares at $5 a share, like I did years ago, and now Amazon shares went to whatever they went to, $1,000, and then they split, and then they went to $100. If I was looking at cost basis and I was trying to determine what level I was trading a covered call against the cost basis of $5 that's been split, so my cost is like whatever 50 cents a share or something, it would sound so ridiculous for me to say, well, I'm basing my covered call strike on my cost basis. So we have to use the exact same logic on the other side. At any time, we have to consider what is the current price of the stock. That's what's important. Completely irrelevant that the stock traded at a super high multiple in the past, because we aren't trading in the past, we're trading today, or the stock was trading at a super low valuation in the past. Neither of those things are relevant. Stock price today is relevant. How much money we're making off today's value is relevant. That's the only thing that we can look at. I'm going to wait and see what tomorrow goes for sure. Christina, for me, what I do with covered calls all the time, I just wait till extrinsic value is gone. So, and then Just Some Idiot says, fair enough, calls rarely get assigned early. Well, calls can get assigned as soon as extrinsic value is gone. So extrinsic value is the only thing that is important in that time frame. I like this guy. I'm glad I found this channel. Yeah, I'm glad you found the channel too. I appreciate it. Thanks for the likes, by the way. I see a couple people have some likes on here, 11 likes. Fantastic. You guys are great. Mike says, good job today without your sharing abilities. Thanks, Mike. Appreciate that. Look at that. It's 12 o'clock already. It's time. Christina, I'm not screwed. I think that, Christina, just to be clear, if I was in that position in Palantir, the real risk is that the stock drops to 38 bucks, which is its fair value according to the data calculation. That's where the risk is. So I don't know what you paid for it. Again, I said that's irrelevant. Right now, it's worth $7,000 that position. So $7,000 drops to 3,800. That's screwed. Right now, $7,000 sounds like it's a win. That will likely be able to generate about $100 a week. So you got a $7,000 position making $100 a week. At the end of the year, if you made $100 every single week, you would have $5,200 in cash and still have the $7,000. That is an extremely lucrative position to be in, but to be cautious, the risk is definitely to the downside on that position, not to the upside. If it continues to go up, that is making it safer for you and more likely you're making money, but it does not sound like it has been a loser so far. So congrats on it. I thought it was the opposite. My cost is $16.49. Fantastic, but it's irrelevant. It's worth $7,000 right now. Just some idiot on YouTube, no brother. If I sell a covered call on, let's say Tesla at 250 for 500 and it drops to 240, I can buy it back at a profit. I just buy the call, then yes, that's bullish. Am I wrong? Well, the covered call has stock. So if the stock drops, then you've lost $10 on the stock. And you've made $500 on the call. So you're down $500. That's a loss. I mean, that's a kind of a basic strategy. All you have to do is look at the profit profile of a covered call. It's like a big slope to the downside. If the stock went to zero, you lose all your money. It doesn't matter if you made $500 off the stock, or off the call. You'd have $500 cash in your pocket and then a $25,000 risk or loss. So losing $25,000 or losing $24,500 is the risk if Tesla goes to zero. So it's definitely a bullish strategy. Brian 2407, if it's a dividend payer, don't you need to consider the amount of the dividend when looking at extrinsic value remaining and the ex-dividend date to know a risk of assignment? That is correct, Brian. So if the dividend is larger than the extrinsic value when the dividend is being paid, like on the prior to the ex-dividend date, then you do have to take that into consideration. So again, extrinsic value being the key there. So if the extrinsic value is greater than the amount of the dividend, then it doesn't make monetary sense to have the assignment happen and have those shares called away. Because if somebody did call the shares, if the market maker called the shares away to collect the dividend or not pay the dividend out, as the case may be, the value that they lost in the extrinsic value by exercising the call is greater than the amount of the dividend being paid. So it doesn't make sense. When the extrinsic value is lower than the dividend, then for sure there's going to be assignment because now the market maker is making some money. So it is something to consider. And thanks for bringing it up. I appreciate that. You do have to be concerned with extrinsic value calculation and dividend payout prior to the ex-dividend date. So very, very important. Christina, thanks. I understand more. Great. I'm glad. That's what we're here for. That's exactly what I'm doing. Just a minute. Yes, I'm talking about scalping options. The stock price is irrelevant. I'm holding for long term. That's what I meant. Oh, right. Well, if you're, yeah. But again, when you talk about covered call specifically, covered call is two positions. It is a stock position and it is a short call combined. Otherwise, you're just trading naked calls. So if you're holding the shares, you have risk to the downside for sure. And Tesla has been crazy. I mean, Tesla was almost at $400 and now it's at $250. So depending on where you bought, there's definitely people watching here that are saying, well, I have $40,000 that's worth $25,000 and they're down $15,000 and making $500 at a time. Although that's a decent amount of revenue, it takes a little while to get back up to your 40,000. Okay, it's 12:10. I can't believe we rocked through this. Market is down. Russell's down 2.8%. Dow Jones is down 6.3%. VIX is at almost 50. S&P 500 down 1.25%. NQ down 1.46%. You guys have been fantastic. I'm going to click on the button or the screen that says let's get rich together, and appreciate your patience with me with my my non-functioning setup here. So I'm going to get that sorted, and we'll see you guys on Tuesday next week. And my patrons, I'll see everybody on Thursday. Thanks so much, everybody. Take care.